Hello everyone, welcome to the class of Introduction to Finance. Today let's start chapter 7, Bonds and their valuation. There are mainly 4 parts in this chapter. The first part discusses key features of bonds. The second part discusses bond valuation. The third one is measuring yield, and the last one is assessing risk. And basically we're going to spend 4 classes on this chapter, and each class we're going to cover one topic. And also this is going to be our last chapter for this course. I initially wanted to add in chapter 8, but later I thought that in any case chapter 8 we won't have enough classes for it, especially given that next Tuesday we're going to have a guest lecture. So therefore we won't be able to kind of finish the chapter 8, and even if we do, it's going to be just a small part of it. So let me just add back that time to chapter 7 to make it clear for you. Chapter 7 is actually a very good example of applications of time value of money. So it's better that I try to explain this chapter well and clear as possible, to you, rather than spending the limited time on 2 chapters, and in the end you kind of don't get any one of them. So chapter 7 is going to be our last chapter, and today we're going to discuss the first topic of chapter 7, which is the key features of bonds. This is the outline of this chapter. This chapter actually has lots of material. So firstly we discuss who issues bonds. So there are mainly several parties: government, including federal government and local government, and then financial institutions, and then also corporate. So these are the issuers of bonds. And then we're going to discuss the key characteristics of bonds. So basically that will be the main topic that we're covering today, like the key features of bond, including par value, coupon interest rate, maturity date, call prevention, sinking fund, and other features. So today we're not going to discuss too much calculations. It's mainly these terms, these concepts that I want you to understand. Then the third one is bond valuation. So this one basically asks you to calculate the fair value of a bond. So you know how to value a bond. So this is bond valuation. And then the fourth one is bond yields, including yield to maturity and yield to call. So these are 2 different types of yields, and our goal is for you to understand how to calculate each of them. The fifth one is changes in bond values over time. And then the sixth one is bonds with semi-annual coupons. So we're going to cover the first one, this one, key features of bonds, in today's class, and we leave bond valuation and bond yields in the second class. In the third class, we are going to discuss the changes in bond values over time and bonds with semi-annual coupons. And then the last one we discuss as bonds riskiness, including price risk and reinvestment risk, and how to compare price risk and reinvestment risk in different types of bond. Then the last one also including default risk. So this is basically the outline of this chapter, and also our plan on how to proceed. So there are 4 learning goals in this chapter. The first one is to identify the different features of corporate and government bond. So basically that's what we're going to do today. I didn't highlight it because this part doesn't really involve calculation, but it's important that you understand the meaning of each features. So although I didn't highlight it because it's not tested directly, but it's still important. The second learning goal is to discuss how bond prices are determined in the market, what the relationship is between interest rates and bond prices, and how a bond price changes over time as it approaches maturity. Yeah, so basically this is related with the bond valuation. And the third one is calculate the bond's yield to maturity and yield to call, if it is callable, and determine the true yield. So this is about the bond yields, the two yields. And then the last learning goal is to explain the different types of risk that bond investors and issuers face, and discuss how a bond's terms and collateral can be changed to affect its interest rates. Yeah, so basically there are only 4 learning goals in this chapter, and all of them are kind of important. The first one is not highlighted because it's not directly tested in the quiz, but it's still important for you to understand how those calculations are conducted in those later 3 learning goals. So first, let's discuss what is a bond and who issues bond. A long-term debt instrument in which a borrower agrees to make payments of principal and interest on specific dates to the holders of bond. Yeah, so this is what the meaning of a bond, or the definition of a bond. First, it's usually long-term, and it's debt instrument, meaning that somebody borrows you money and then they promise to pay back. So including both the principal and the interest on a specific date in the future. And one grouping based on the issuer of the bond is like bond can be categorized into the following 4 groups. The first one is treasury bond. This is the bond issued by the federal government. For this one, it's always default risk free, because the federal government will never default unless the federal government collapses, right? But yes, the federal government will always pay you back, but it doesn't mean that it's completely riskless. It's default risk-free. Doesn't mean that there are no any other risks involved. Yeah, remember, we actually discussed many risks before, including liquidity risk, including maturity risk, and then today, not today, but in this chapter, we're also going to discuss the price risk and reinvestment risk. So all those risks are, the treasury bonds are not completely immune to them, but default risk, yes, treasury bond doesn't have any default risk. The second one is corporate bonds. So these are the ones that were issued by the corporations. Third one is municipal bond. So these ones are issued by the local government. The last one is foreign bonds. So these ones are issued by the foreign government. It's the same as the treasury bond. They are kind of both issued by the government or the federal government, like at the national level. But treasury bonds are issued to the domestic population, to the domestic market, while the foreign bonds are issued in the international market. So in this case, the investors are foreigners, no longer the domestic institutions or households. Right? But the treasury bonds are issued in the domestic market. So that's the difference here. Bond markets are usually primarily traded in the OTC market. OTC means over the counter. That also means that there's no exchange. It's not like there's Nasdaq or there's or New York Stock Exchange. There's no such market, but it's usually largely depend on negotiations. So that's why it's an OTC market. Most bonds are owned by and traded among large financial institutions. Yeah, so households are participants in the market, but not as important as those financial institutions. Especially banks, they are not allowed to invest in stocks. So bond is their main investment. If they don't lend out the money as loans, then they will invest that money in the bond market. The Wall Street Journal reports key developments in treasury, corporate, and municipal market. Okay, now let's discuss the key features of a bond. The first feature is par value. Par value, we actually discussed this one before, right? If I remember it correctly, par value is basically just the face value. So it's face amount of the bond which is paid at maturity. Usually it's $1,000, especially for treasury bond. They're always $1,000 face value per share. And then the second one is coupon interest rate. is the stated interest rate paid by the issuer. Yeah, so and it's generally fixed. Yeah, so we usually use the coupon interest rate times the par value, then we get the payment, the interest payments each year. Yeah, but if the interest payments is calculated twice a year, like the bond is compounded semi-annually, then the coupon interest rate times the par value gets you the annual interest payments. Then you have to divide by 2, either 2 or the number of periods in the year. Right? If it's semi-annual, then you divide by 2. If it's quarterly, then you divide by 4. Then you will get the interest payments for each period. And coupon interest rate multiplied by par value to get dollar payment of interest. That's exactly what I was just discussing. And then most are fixed during the bond's life. The coupon interest rate doesn't really change much. So it's more or less just fixed until it matures. And zero coupon bonds pay no coupons but are offered at a discount below their par value. Yeah, so zero coupon bond, there are many bonds that do not really pay you interest, but you get the return not from the coupon because it's zero coupon bond, right? But you get the return from the price difference. So usually if you hold it to maturity, then it's between the purchase price and the face value. If you don't hold it maturity till maturity, then it's the price, the purchase price and the selling price, right? But zero coupon bond do not pay coupon, therefore they are always sold at a discount below their par value. And the last one is original issue discount bonds. These are the coupon interest are not enough to induce investors to buy them at par. So it means that they do issue, they do have coupon. They are no longer zero coupon. They do have coupon interest rate, but interest rate is too low. Therefore, they are still not high enough for the bond to be buy at par. What is the condition for a bond to be selling at a par? The key condition here is that the coupon interest rate equals the market interest rate. If that's the case, then the face value exactly equals to the fair price. Then in this case, we say the bond is selling at par. But because for zero coupon bond, they do not have coupon at all, therefore their price are always sold at a discount. And if it's original issue discount bond, meaning that yes, they do have coupon, but again their coupon is interest rate is too low. Still, it helps raising the price, but still not high enough for the price to reach its par value. So that's coupon interest rate. The key thing here I want you to remember is coupon interest rate is important for you to calculate the payment each period. And how to calculate the payment? Just use the par value times the coupon interest rate. If you don't calculate payment, then it's going to be difficult for you to get the right answer, especially for the time value of money questions. Yeah, so this is the key. Just remember, using the par value times the coupon interest rate, you get annual payment. Yeah. Here's an exercise question. A zero coupon bond is a bond that pays no interest and is offered or initially sells at par. So these bonds provide compensation to investors in the form of capital appreciation. True or false? I pause here a little bit for you to think about it. Next, I'm going to let you know the answer. So the answer is false. Why is that? It's like this part. A zero coupon bond is a bond that pays no interest and is offered at par. If the bond has no interest, then it will never be offered at par. Why? Because it doesn't make sense if the price right now is the par value, and then after a number of a period or a number of days when the bond matures, you still get paid the par value, the face value, right? So in this case, there is no gain for you at all in any case. If you don't if you consider the opportunity cost, you are actually even losing money, right? So in any case, a zero coupon bond will never be sold at par, unless maybe it's negative interest rate, which is very rare. Otherwise, a zero coupon bond should always be sold at discount. Therefore, the compensation is actually paid in the form of the price difference between the par value, the face value, and the purchase price. Yeah. So that's this question. So the correct answer is false. Okay, let's continue. The next feature I want to discuss about is the maturity date. So this is the date on which the bond must be repaid. Yeah, that means the bond has to clear after that date. And the original maturity, the maturity at the time the bond is issued. So that's the maturity date is based on the original maturity, and it's basically never changes, right? Once the bond is issued. And then the fourth one is issue date. So this is when the bond was issued. This helps for us to calculate the investment period. But if you bought it right from the beginning, yeah, so that's the issue date. These two dates are kind of straightforward. I guess I don't need to explain too much. The third one is yield maturity. So this is the we usually call them YTM. There's another one called yield to call. We call them YTC, but we will discuss that one later. So for yield maturity, this is the rate of return earned on the bond held until maturity, also called the promised yield. Yeah, so this is the potential yield you are going to earn if you hold the bond until maturity. And then in this case, we know the number of period. We also know the payment. We also know the price, the purchase price. That's the price you buy the bond right now. You paid for the bond right now, right? And then we also know the future value, which is the par value of the bond. Therefore, we can calculate the yield, I/Y, the annual yield for this bond. And okay, so we now have finished discussing like 4 features already. And then the next one is the call prevention. This one allows issuer to refund the bond issue if rates decline. It will help the issuer but hurts the investor. Yeah, so call prevention means that if the company feel continue paying interest on this bond is no longer financially smart for them to do so, they can decide to call back the bond, meaning that they buy back the bond from the bondholders and cancel out such debt. Yeah. So, and they usually do it when rates decline. Yeah. So for the bond issuers, they require higher yields on the callable bond. But in many classes, callable bonds include a deferred call prevention, which means not callable until several years after issue, and a declining call premium, that is the additional amount greater than the par value. Yeah, so this is like explaining the meaning of those call preventions, right? Again, here's another exercise question. A call prevention gives bondholders the right to demand or call for repayment of a bond. Typically, companies call bonds if interest rates rise and do not call them if interest rate decline. Yeah. So is it true or false? You can think about it before I release or let you know the answer. In this exercise, there are 2 sentences, and actually To be honest, both sentences are wrong. The first one says a call prevention gives the bondholder the right to demand or call for repayment of a bond. It's not the bondholder that decides the right of the demand or the call for, right? Or it's the issuer, it's the bond issuer, not the bondholder, right? And then the second one is that typically companies call preventions if interest rates rise and do not call them if interest rate decline. Yeah, so this one is also wrong because companies usually call bond if the interest rate is declining. Why is that? It's because if the interest rate is declining, then means that the interest rate was high, now it's going lower. Then that means if the interest rate is higher than the coupon interest rate, then in this case, maybe it's better for the company to buy back all the bond and then issue new bond, because they can take advantage of the lower interest rate in the future and issue bond at a lower coupon interest rate, right? So the bondholders will only buy back the bond or call back the bond if the interest rate is declining. It means that right now the interest rate is high, but I expect that it's going to default in the not default, but decline in the future. Therefore, companies call bonds if interest rate rise. If interest rate declines, and do not call them if interest rates rise. So the answer is B, false. Next, let's discuss sinking fund. First, what is a sinking fund? Prevention to pay off a loan over its life rather than all at maturity. That's arrangement of a sinking fund. It's kind of similar to amortization on the term loan. Yeah. And then it reduces risk to investors, shortens average maturity. Yeah, so that's basically the meaning of a sinking fund, why it exists. But not good for investors if rates decline after issuance. Yeah, so this slide explains how a sinking fund executed. For sinking fund, again, as I said before, it's mainly calculations in this chapter. So for such concept, I do not really expect you to fully understand like every corner of it, but I expect you to have a big picture of it. You know at least roughly what it means for, right? So for a sinking fund, you just know that it's kind of the borrower forces the issuer to pay back the bond gradually over time, not all paid at once in the maturity, because they are worried that the bondholder or the issuer may not have enough money at that time. So the issuer may have to the issuer have to pay back the bond gradually over its life, rather than all at maturity. Yeah, so the issuer can handle the sinking fund requirement in either of two ways, at a cost which is either the par value or the bond market price, whichever is lower. Yeah. So there are two ways. The first one is to call X% of issue at par for sinking fund purposes. Yes, and this is likely to be used if the market interest rate is below the coupon interest rate and the bond sells at a premium. So in this case, the company should call like a certain amount of the bond each time for the sinking fund purposes. And the second one is buy bonds in the open market. So this is likely to be used if the market interest rate is above the coupon interest rate and the bond is selling at a discount. Therefore, means that the market price is lower than the par value. Therefore, they will pay relatively lower price for it, right? But if the market interest rate is lower than the coupon interest rate and the bond is selling at a premium, then in this case they want to buy back the bond at its par value. So these are the two ways that sinking funds are executed. But again, as I said before, this part you don't really have to know every details of it. You just need to kind of have an understanding. This is like amortized corporate loan. It's a bit like mortgages, where households buy a house, use it as a collateral, and have to pay back the loan like every month. The bond borrows money from us. They don't need to pay back to pay every month, but we also want them to pay, at more frequently than just pay it all at once in the when it matures. So these are the other types of bond. Convertible bond means that the bond can be exchanged for common stock of the firm at the holder's option. Yeah, it means that right now you bought a bond, but the bond can be turned into stocks once you meet all the requirements. The second one is warrant. This is long-term option to buy a stated number of shares of common stock at a specified price. So convertible bond means that you can change the bond, transform the bond, use the bond to turn it into a stock. But the warrant doesn't really need you to use the bond to replace the bond with the stock. It just gives you an option to buy the stock, like leaving aside the bond. The bond is still there, but you have the right to buy stock at a specified price. Putable bond means this one allows the holder to sell the bond back to the company prior to the maturity. So callable bond is like allows the issuer to buy back the bond, but putable bond allows the holder, like investors like us, to sell the bond back to the company prior to its maturity. It's the same as the callable bond in the sense that the bond is bought back by the company, but it's different in the way that who has the power to do so. Income bond pays interest only when interest is earned by the firm. If the firm didn't make money, it's instead losing money, then the income bond won't pay you any interest. Indexed bond is where the interest rate paid is based upon the rate of inflation. So they try to basically use this indexed bond to hedge against inflation. So that's why the interest rate is paid based upon the inflation rate. Yeah, so basically that's it. So the rest are the value of financial assets, the bond valuations. So I'll leave this part in our next class. Thank you all for attending today's class. I'll see you next time.